Hi, and welcome to the Day Trading for Beginners podcast. This is episode 21. And in this episode, we are talking option spreads for beginners. So my name is Tyler Stokes from StokesTrades.com. I'm on a journey to become a full-time day trader, and we are sort of wrapping up our section on options. So next week, sort of the end of April, we're going to have a podcast where we review everything that we've spoken about regarding options, and then we're moving on to technical analysis. So if you want to access the 6-month blueprint, the blueprint that I'm following, which outlines everything I'm doing in the first 6 months of this journey, you can go to stokestrades.com/blueprint. You can download a free copy, and you can find a link in the show notes below if you want to follow along with that. Our community on School is actually growing quite nicely. We have 100 members now, over 100 members. People are starting to participate. So it's absolutely free. There's no courses for sale. No one's selling you anything, but we have all free courses regarding options, day trading that we're slowly building out. And if you want to come and, introduce yourself or find an accountability partner, using that community can be a great way for you to stay consistent if you're looking to become a full-time day trader as well. It certainly has helped me. We've gone 21 weeks where we've published something and we've learned something. So I've come a long way from January, the beginning of this year where we started this. Now we're at the end of April, and we've gone through quite a bit, and I've already learned so much. And being accountable, posting every week in that community has really helped me, stay consistent and continue to look forward to learning something every week. And by the end of the year, I will be so much more ahead. And that community has really helped me stay consistent. So it can do that for you as well. And again, it's absolutely free. So let's jump right into it. Option spreads for beginners. So again, if you've been following along, I would recommend that you have a good understanding of, what options are, how you can buy them, how you can sell them, a little bit of the pricing dynamics of an option. So its intrinsic and its extrinsic value. And then we spoke about the Greeks last week. So you kind of want a good base if you're going to jump in and start learning about these option spreads. So again, this episode is going to be very much a beginner sort of introduction to option spreads. I would recommend that you subscribe to the YouTube channel as well, because with some of these episodes, I will have a video episode where we sort of go over some examples on a whiteboard. And it's much easier to visually kind of see some of these things. I think at the end of this podcast, I'm going to walk through an example, but you will probably want to see that on a video format, rather than just listening to it, to really sort of let everything sink in. But I am going to talk through it here on the podcast, but I would recommend that just go to the YouTube channel. You can find it in the show notes or find it on the website. Subscribe there, and then any episode that we also use and convert to a video format, I think it's going to be helpful for learning as well. But for these option spreads, the way I've kind of looked at it is I kind of just wanted to understand what they were, exactly what they were, and sort of how they worked. And I kind of, on purpose, sort of avoided studying any strategy. So for me, once you kind of think about what these spreads are, how they work, but if you throw that extra layer of, strategy of why you might do this versus that, I think for me, I got a little bit tripped up. In the next few months, we're going to learn technical analysis. So we'll have a better understanding of why we might be bullish or bearish on a stock. But if you sort of ask me that now, or say use this option spread when you're bullish about the stock, well, in my mind, I kind of say well, what makes me bullish about the stock? I don't know. So it just adds a little bit of confusion. So for me, going over this in this podcast, and when I kind of learned it, I tried to avoid thinking too much about the strategy or why I would be setting up this spread, or why I would maybe want to do that, instead of just kind of learning exactly, what it is, what the definition is, and how they work. So that's kind of what I'm going to try and portray in this podcast as well. So we're going to try not to talk too much about strategy. For me, that just seems to make the most sense when I was sort of learning what these option spreads were. So I just wanted to get that out there. So an option spread. Okay, so let's talk what is an option spread? So what it is, it involves basically buying and selling an equal number of options contracts on the same stock. So this can be either call options or put options, but not a mix of both. And the options must differ in strike prices and or expiration date. So basically you buy a call option and you sell a call option at the same time on the same stock. And then the difference is either the strike price is going to be different or the expiration price of the option is going to be different, or the strike price and the expiration dates will be different. So that's basically what it is. And they're sort of categorized into three different spreads. One's called a vertical spread, a horizontal spread or a calendar spread, and then a diagonal spread. So vertical spreads seem to be the most popular from what I've sort of gathered. And some of the examples that we're going to use, we're going to just talk vertical spreads. But let's just go over exactly what each one of these spreads are, and then we'll do some examples with vertical spreads. Okay, so a vertical spread. So here, the strike price is going to be different. So everything that's going to be the same, except the strike price is going to be different. So let's just talk examples with Tesla stock. So one vertical spread might be with a call option. So what you would do to set up this vertical spread, you would buy a call option with a strike price of $150 with an expiration date in 1 month. So if we sort of review what a call option is, again, that's a contract that gives you the right, but not the obligation, to buy Tesla stock at $150, and it will expire in 1 month. So as the stock goes up above $150, you have the right to buy it at $150. So as the stock goes up, you're going to gain with that contract. So what you would do for a vertical spread, you would buy a call option with a strike price of $150 that expires in 1 month. And then at the exact same time, and you would just do this, seamlessly in your brokerage account, you sell a call option with a strike price of $160 expiring in 1 month. So the difference there is going to be the strike price. You buy a call option for $150, and at the same time, you sell a call option for $160. So that is what a vertical spread is. And later we're going to talk about, why you would want to do that, what implications that gives you, in terms of, your price and your risk. We'll talk about that later, but that's exactly what a vertical spread is. And then for put options, it's the exact same thing. You would maybe buy a Tesla put option with a strike price of, say, $150 that expires in 1 month. And at the same time, you sell a Tesla put option with a strike price of $140. So different strike price that expires in 1 month. So that is what a vertical spread is. Very simple to understand. You're buying and selling options, either call options or either put options on the same stock. And what differs is just the strike price. So you're going to buy one with a higher strike price and sell one with a lower strike price for puts. And then for calls, popular is to buy the lower strike price and then sell the higher strike price. But again, we're going to get into, you can actually have that flipped. You can be, buying this higher strike price and selling the lower strike price. But the difference is just the strike price. The expiration dates are the same. So that's a vertical spread. Now, a horizontal spread, if you think about it, it's just going to change in terms of the expiration dates. So for our example, we might buy a call option on Tesla that has a strike price of $155, let's say, and it expires in 6 months. And then at the exact same time, we're selling a Tesla call option with the same strike price, $155, but it expires in 1 month. So the difference there, it's a horizontal spread because the difference is the expiration date. One expires in 6 months, so it's a longer expiration date, and the other one is going to expire in just 1 month. So that's a horizontal spread, or sometimes referred to as a calendar spread. Now, the other one, a diagonal spread, if you can think about it, you're basically going to combine both of them. You're going to have different strike prices, different expiration dates, but it's going to be along the same stock. So again, for our example, we might buy a Tesla call option that might have a strike price of, say, $160 that expires in maybe 6 months. And then at the exact same time, we sell a Tesla call option with a strike price of maybe 165 that expires in just 1 month. So strike prices are different. Expiration dates are different. That's a diagonal spread. So those are sort of like the three main types of spreads. And again, we just sort of learned what they are. Very easy to understand. What becomes a little bit difficult and might take a bit more time to understand, and you might need to draw these out or write these out and think more about them, is why you would do that and what implications each has in terms of what you're risking and what you can potentially gain in terms of profit. So we're going to run through an example sort of later on. So those are the spreads. Now, remember, just a quick summary there. These option spreads, again, you're buying and selling the same amount and the same type of option. So you're either going to buy and sell a call, or you're going to either buy or sell a put. You can't do a call and a put. You can't mix them up. It's a call or it's a put, and it's always the same amount. So if you buy one call, you have to sell one call, or if you buy 5 calls, you sell 5. So the spread has to be the same amount, and it has to be either calls or puts, and it has to be under the same stock. And then what's different is either the strike prices, and that's a vertical spread when the strike prices are different, the expiration dates, that's horizontal, so calendar spreads. And then if they're both different, that's a diagonal spread. So that's basically, again, quick definition of what they are. Now, there are also these things called credit and debit spreads that relate to these, and we're going to talk about them in terms of vertical spread. But I don't know about you, but every time I hear credit and debit with investing, I seem to get confused with a credit and debit when it comes to accounting. So back when I was in university, I studied finance and I studied accounting, and the accounting use of the word debit is a little bit different than the investing term for debit. So I wanted to kind of run through the trading context of credit and debit, because it's something I needed to review, and it helped me sort of understand the whole credit and debit types of spread. So a debit spread. So when you initiate what's called a debit spread with investing in options, you're paying out more money than you are receiving. So this results in what's called a net debit. So when you're paying out more than you get in with these options, it's a net debit from your trading account, meaning your account balance decreases by the amount of the debit. So in options trading, debit means you're spending money. Credit spread, on the other hand, it's when you initiate a credit spread, you receive more money than you pay out. So this results in a net credit to your trading account, meaning your account balance increases by the amount of the credit. So again, in options trading, a credit means you are receiving money. And we'll get into that in just a second. But if we just think back to that first vertical spread that we just talked about, where we buy a call option with a lower strike price of 150, and then we sell a call option with a higher strike price of 160, that call option that we buy, it's going to be more expensive because the price of the strike price is lower. It's closer to the stock. It's closer to being in the money. So it has more value than the call option with the higher strike price. So once we do that vertical spread, we're going to be paying more for the call option that we receive when we sell the call option at the same time. Therefore, we have a debit. That would be a debit spread because we have money. We're spending money there. We've spent more buying that call with the lower strike price than we received when we sold the call in the same stock with a higher strike price. And again, we'll get into an example that talks a little bit more about that, but that's the difference between a debit and a credit spread. And then, the accounting world, a debit, is an entry that either increases an asset or an expense account, or decreases a liability or an equity account. So it's positioned on, the left side of the accounting ledger. And every time I hear debit, I always think that it's something that increases an asset. And then with accounting, a credit, it's an entry that decreases an asset or an expense account or increases a liability. So that's what I had in my head. So if you have that in your head, if you have an accounting background, just know that, it can be a little bit confusing. There's some sort of confusion that arises because in accounting, a debit to a cash account means an increase in cash, while a credit to a cash account means a decrease in cash. But that's not what it's like in the trading world. Again, just to be crystal clear, a debit in your trading account balance, like paying for a debit spread, which we're going to talk about, it decreases your cash account. And then a credit to your trading account balance increases your cash. So just keep that in mind. And I hope that I didn't confuse you even more, but I needed to review that. So debits are reduce your cash, credits to your trading account increases your cash. So again, debits, it's sort of like money out. Credits, it's money in. So again, I needed to personally review that. So there are things called debit and credit spread. So I sort of just described a debit spread when I talked about that first stock, that first call option vertical spread that we kind of talked about earlier. So a debit spread, it's an option trading strategy that results in the net cost, so a net debit to your account. So this happens because you're buying an option that costs more than the option that you are selling within your spread. So again, here's a really quick breakdown. So for call options, you buy a call option with a lower strike, and then you sell a call option with a higher strike. You are going to be buying something that is more expensive. So that is going to be a debit spread. And then for puts, it's sort of the other way around. When you buy a put option with a higher strike price, and then you sell a put with a lower strike price, that's going to be a debit because it's going to cost you more in terms of what you're buying versus what you're selling. And then, credit spread, again, it's the other way around. With a credit spread, you sell an option that generates more premium than the cost of the option that you buy. So the concept of credit comes from the fact that the net transaction results in a credit to your trading account. And we just talked about that. That means money coming in. So you receive more money from selling the option than you spend on buying the other option in your spread. So quick examples for calls: when you sell a call option with a lower strike price and then you buy a call option with a higher strike price, that's a credit spread because you are getting more money for that option that you sold. And then for puts, it's the other way around because, again, a put option gives you the right to sell a stock at a certain strike price. So if that strike price is higher and you sell that, then you're going to have a credit to your account. So again, something that you might need to kind of review a little bit on your own if it's not sort of sinking in, but that is what are called debit and credit spreads. And they are, sort of built into these different vertical spreads depending on, if you're buying or selling a more expensive option, either a call or a put. So again, key points there. Debit spread means you're buying an option with a more favorable strike price in terms of a vertical spread. So you're paying more of a premium, and then you're selling an option with a less favorable strike price. So the premium that you collect is going to be a little bit less, resulting in your resulting transaction there is going to be a net debit. So you're a little bit of money out. And then again, credit spread, it's when you sell an option with a more favorable strike price, where you collect that premium, plus buying an option with a less favorable strike price. So your resulting transaction there is going to be a net credit to your account. So there are, unfortunately, a few other names for, these popular vertical spreads. And I thought I would just talk through them here on the podcast. And again, I would recommend you reference the article that I have below, as well as the video, to sort of see some of these visually as well. But we'll just kind of go through them because sometimes listening to this and then talking through it yourself is going to help you understand these different terms. And then as soon as you can, associate one with the other, you'll understand that they sort of all mean the same thing. So there's this thing called a bull call spread. So a bull call spread, it's the same as a long call spread or a call debit spread. So if we break down the terms, we can see why these all basically mean the same thing. So a bull call spread, the word bull it indicates that the strategy is used when you expect the stock price to go up. So that's bull. So you expect the stock price to go up. Bull call spread. So the word call obviously means you're using a call option. And then spread again implies that, we are buying and selling two options at the same time. So basically bull call spread, it's a bullish sort of strategy. We're thinking up and to the right. Long call spread, it means the exact same thing. Long is the same thing as, bull. We're buying or we're holding something that's going to benefit us as the stock price increases. And again, call and spread, we just talked about what those were. It's a call option here. So we're buying and selling a call option. And then spread, that's exactly what that refers to, is we're buying and selling something at the same time. So long call spread, bull call spread, they mean the same thing. And then call debit spread, we sort of talked about that when we just talked about debit spreads. Again, the word call, obviously we're doing a call option. Spread, we just talked about that. We're buying and selling something. So don't get confused there. They all mean the same thing. And then call debit, basically that means that we're paying to enter the trade. So again, we're buying a more favorable strike price and we're selling a less favorable one. And we just talked about that. That creates a debit spread. So again, a bull call spread, long call spread, and a call debit spread, they all mean the same thing. And at first, when you hear that, you might get confused, but when you kind of look at it a few times and you sort of break it down, I think it'll start to become second nature. A bull and a long, sort of the same thing. And then a call debit is, bullish. You're buying something that's more favorable. That call option is more favorable. So you want the price to go up. So now we can do that with, three other types of spreads. And that is, these are also called, there's another one called a bull put spread. So remember, put, we can sort of interchange that with the word short or selling. So a bull put spread, it's the same as a short put spread, which is also the same thing as a put credit spread. So by understanding these terms, again, if we just break that down, bull means that we're expecting the stock price to stay the same or slightly rise with these type. Put refers to put options, and then spread, again, we're buying and selling a put option. So we're buying and selling something at the same time. It's a spread. Short put spread, again, short highlights that you're selling a put option, which generates immediate income. And then spread, again, is going to just indicate that we're buying and selling options. And then put credit spread, the credit means that we're going to receive more money from the option that we sell as opposed to the option that we buy. So bull put spread, short put spread, put credit spread, they all mean the same thing. And then the next two, I guess we won't kind of run through like we've just have, but a bear call spread, that's going to be the same as a short call spread, and the same thing as a call credit spread. And then a bear put spread is going to be the same thing as a long put spread, and the same thing as a put debit spread. So if you want yourself, you can kind of look at those and sort of break those down again, or just memorize them, or kind of go through an exercise where you talk yourself through them. And then you'll be able to sort of understand that, a bear put spread is the same as a long put spread or a put debit spread. Okay, so let's talk through an example. And again, a visual representation of this might be helpful, but we'll talk through it, and hopefully you can kind of listen and understand. And again, those four different spreads that we went over, I understand if you hear that for the first time, it's probably not going to sink in, but just understand that those all mean the same thing, and you're going to just have to try and figure out a way for you to remember them. For me, just looking at them more and more and more, using them in more discussions, watching more videos about them, and then just kind of being able to remember that certain things mean the same things. Eventually it's going to sink in, and hopefully it does for you as well. So let's walk through an example of a vertical spread. And we're going to have, I think, a few scenarios here where we can kind of hopefully sort of see how these spreads work and why you might be wanting to use them as opposed to some other ways of investing and just buying stocks or just buying a straight up call or a straight up put. So we'll run through this. Let's just use Tesla as our example. We seem to always use that, which is fine. And we're going to basically compare the differences between buying stock outright, buying a simple call option, and then setting up a vertical call spread. And we'll run through the different scenarios. And again, this is going to demonstrate, why using vertical spreads can sometimes be a more advantageous option when the other methods, especially in terms of risk and cost efficiency, might not be the greatest option for you. And again, running through this can help you visualize why you might be buying a call option and then selling one at a different strike price, and why you would sort of want to do that. So let's set this up and let's pretend that the Tesla stock price, it's currently $150. So our first option is we want to just buy Tesla stock outright. So let's pretend that we purchase 100 shares of Tesla and it's currently trading at for $150. So what that's going to do is that's going to cost you $15,000. If you want to buy 100 shares of Tesla at $150 per share, you've got to fork over $15,000. So your potential risk is really, your entire amount. Tesla's not going to go to zero, but if it did, you would lose your entire $15,000. And then theoretically, your potential reward is sort of unlimited because there's stock can continue rising. Obviously, in the real world that won't happen, but you have potential upside. Obviously, every time the stock increases, your by $1, your investment increases by 100 because you have 100 shares. So if the stock goes up to 151, then your $15,000, you've made $100. So obviously, there's a lot of potential reward, but you have a lot at risk, and you've had to spend $15,000 to buy those shares. So then the other option here is, buying a simple call option. So let's pretend that we bought a call option that had a strike price of $150. So it's right at the money, and it expires in 1 month. So the premium for this option, let's assume it's $10. So $10 per share. So each contract represents 100 shares. So it's going to cost you $1,000. So that's the premium that you paid to buy that call option for the strike price of $150. It expires in 1 month. It costs you $1,000. So your potential reward, again, it's also theoretically unlimited past your break even point of $160. So that break even point, remember, is the stock price at expiration, that strike plus your premium. So you have the right to buy Tesla at $150, but you paid $10 for that. So if Tesla gets to $160, then basically you broke even. Anything above $160, you will make money with that call option, and you spend $1,000 for it. And then the third option here is setting up one of these spreads, a vertical spread. So what we could do is we can buy a call option with a strike price of $150 that expires in 1 month. And we're going to assume that costs $10. And then at the exact same time, here's our vertical spread now, we sell a call option with a strike price of $160 that expires in 1 month as well. And let's assume that the premium there was $5. So we received $500 for that, but we spent $1,000 on the call option that we bought. So we have a net debit of $500. So we paid $1,000 for the call option, and then we sold a call option that was worth $500. So we are basically net debit. We paid $500 for this position. So our risk here is $500. That's all that we have risked. Excuse me. That's the risk that we have for this position. And then our potential reward, it's actually capped at $500 as well. And again, you might not be able to think the math through in your head, but if you calculate the difference between the strike prices and then you take away that net debit, it's going to be basically $5 per share or 500 per contract. So, if the stock goes up, you're going to make money on the call option that you bought, but it's going to be sort of balanced or counteracted by the option that you sold. And then the max is going to fall at 500 per contract. And again, that math, it's hard to dictate it out on a podcast, but basically you've risked 500 and then the max you can profit is going to be 500 as well. And again, that is because you're going to, as the stock price goes up, you will earn on the call option that you bought, but you have that obligation on the call option that you sold. And then the difference is there, it will max out at 150 at $500. So the break even for this vertical spread, it's going to be the lower strike plus the net debit, and it's going to be $155. And again, you'll have to just take my word for it that that's what it is. The math just requires you to sort of potentially pencil it out. And again, in the video, I will. But what we have there is a break even of 155 and a risk of 500 and a maximum gain of 500. And then if you compare that, to just buying the call option, you're risking more, $1,000. You have, more potential reward, but your break even is also higher at 160. So basically why the vertical spread can be better, firstly, lower cost and lower risk. The vertical spread, it reduces your initial cost. So you don't need to pay $1,000 like you would for the call option. You're paying just $500. And it also reduces your total risk. Not only obviously you pay less, but you're risking less money as well. So less cost outlay and less risk. Basically defined outcomes, both potential reward and risk are clearly defined in a vertical spread. You know the maximum that you can lose, which in this example is 500, and then the max you can profit is going to be 500 as well. So you've got those defined outcomes. And then there's this reduced impact of time decay. Remember that options are running against the clock. They have expiration dates, and you are, the theta that we studied in the last episode on the Greeks is that time decay. So by selling a higher strike price that you do with these vertical spreads, you sort of offset some of that time decay because there's not all time decay just on what you bought. You also are benefiting from that time decay on the call option that you sold. So basically, you when you just have a call option and you haven't sold one, then time decay is all against you. Whereas if you've sold one now, you're benefiting from that with the option that you sold. And then we saw that the break even is more favorable as well. The break even point for the vertical spread, it's $155. It's lower than for just buying the call outright at 160. So it's making, it's easier to profit. So in the long run, if you buy and you set up more of these, sure, if you just do a few, you might have one call option where the stock takes off and you did everything right and you would have made maybe more on that call option. But, if you're day trading over the course of a year, the probability that these vertical spreads are more favorable for you over the course of a year where you're trading, potentially every day, this really, really is going to add up. And this strategy of using vertical spreads, it's going to be much more beneficial for the more active trader. And we can just see that through how these examples sort of work out. And even this break even, your break even, it's 155 versus 160. Over the long run, that is going to make you more money as you make more trades. So if we sort of run through, a few scenarios now with these different options that we ran through versus, buying the stock outright, just buying the call option, or setting up this vertical spread, we can see that there are certainly different return on investments that happen as different scenarios play out with the price of the stock. And then we can sort of see why it can be advantageous to set up these vertical spreads in certain scenarios. So let's just talk, scenario one, where the price of the stock rises to $165 at expiration date. So if we kind of refer back to our option one there, where we just bought the stock, if you bought a stock and we bought the stock for $150 and we bought 100 of them, so now it's gone up to 165. So for the stock purchaser, you've got $15 per share of profit. You had 100 shares. So you've made $1,500 in that time frame. So your initial investment was $15,000. So your return on investment there, you made $1,500 and you invested $15,000. So you made 10% there from the stock price going from 150 to 165 in that time frame. When you are the person who just bought the call option, well, your profit is going to be the new stock price minus the strike price times the contract multiplier there. So that's going to be $500. So again, you have the right to buy the stock at 150. It's now trading at 165, but you paid $10 per share for that. So you're up $5 times 100 shares. So you're up $500. That's the math there. So your initial investment, remember we paid $1,000 for that call option and we made 500. So your return on investment is 500 over 1,000. You got 50% return on investment there. And then if we look for the vertical spread now, the max profit would be reached if the stock reached $165, and that was $500. Our initial investment for that, we remember that was an outlay of just $500. So our return on investment there is 100%. We made $500, we risked $500. So it's 100% ROI when the stock moves from 150 up to 165 in that 30-day window. So very much a very different return on investments in that scenario where the stock rises a bit there. So now, if we look at two other scenarios here, let's look at Tesla stock. If it just rose to $155 at expiration. So it's just gone up $5 in that month. If we look at our stock option, we're going to be profiting here. We profit $500 because the stock rose $5 per share. We have 100 of them. So our return on investment there, it's not going to be much because we invested so much, but we made $500. We invested that $15,000. So that's a return on investment of 3.3%. If we look at the call option, just buying a straight up call, we actually lose. So if we look at the call there at 155, we have the right to buy the stock at 150, and we can currently it's currently 155, so we can buy at 150, sell at 155. So that's 5 there. However, we paid $10 per share, so we're down $500 on the call. So we have a loss of $500 there. So our return on investment with this would be down 50%. We lost $500 on our investment of 1,000. So we are a loss of 50% for the call option there. And then the vertical spread, the outcome is going to be 0. There's no profit. There's no loss because 155 is there's no gain. That's sort of the break even. The spread reaches its break even point there at 155. So again, there's another scenario where the stock just moved up by $5. Obviously, if you own 100 shares, you're going to make some money even with that small rise. With the call option, you will actually lose it a little bit. And then with the vertical spread, you would break even. And then with scenario 3, if Tesla now drops to $130 at expiration date, well, the stock purchase, you're down $20 per share. You own 100 shares, so you're down $2,000. So your return on investment there, you're down 13%. If you bought just a call option, you would just lose your $1,000. So your premium is lost. Your stock option is out of the money at expiration date. So you've lost 100% of your investment there, just $1,000. And then your vertical spread, again, you would be losing as well. You get a net loss of $500. That's just your max loss with that vertical spread that you set up when the stock drops like that. So there you can see that these scenarios, they sort of highlight, different financial dynamics of each trading strategy. So the stock purchase, it provides a solid but lower percentage gain in a rising market, but also exposes you to more capital requirements. So you need $15,000, for that particular investment. And then when the stock falls, you are experiencing much higher losses. Obviously, you won't lose until you sell the stock, but you are certainly down on your position to date. So when you just buy the call option, it's a straight up call, it offers, more leverage. So higher percentage gains from the smaller moves in the stock price. But, there is a risk of total investment loss when the stock doesn't move your way. Your call option expires worthless. You've lost your initial investment, although it was just $1,000. Then the vertical spread, you can see in those scenarios, it offers the best risk management, significantly limiting both the potential loss, but also reducing the capital that you required. It was a $500 cost. You just risk $500, and then the gains are certainly capped, but the return on investment, it's much more impressive when the stock does move in your favor. And this sort of just shows that you can be much more efficient with your capital when you set up these different types of spreads and you're using options. You just have much more flexibility. And I think that, in studying options for the last little while, this example and finally getting to this point where we're talking about spreads, we know what options, how they work, how you can buy them, how the price differs, and so on. And then using these spreads, I can sort of see now where in all those first sort of introduction videos that I watched about options, they always talked about, you have so much more flexibility with your trading and with your investments. And at first, when you don't know any of this, you kind of think like, what does that mean? What did they mean by more flexibility? But there you can just see in that simple example, it's not hard to set these up. And you can argue that you just have so much more risk management is much more effective there. You're limiting your losses, and you just have more flexibility, and you're just more efficient with your money when you use some of these tools. So I hope that you found this useful. It's a little bit, again, I mentioned a few times, the video version of this can be easier to sort of understand some of these concepts rather than just listening to them. But even, any sort of input that you take with options, listening to a bit, you might get a nugget from, this podcast. You might need to watch some more videos or someone else's tutorials for everything to sort of sink in. But hopefully you've learned something from this. And I would thank you for listening. Subscribe to the podcast. Do consider jumping over to the YouTube channel, subscribing to that. And again, like I mentioned, if you want to come join our community on School, absolutely free. It can help you continue to stay consistent with your own journey of, becoming a trader and learning more about options and investing. And you'll find, links to that in the show notes, or just go to the website, stokestrades.com. So again, thanks for listening to this episode. Next week, we are going to do a full review of everything options, and then we're going to move on to technical analysis. And again, we are well on our way to completing this first 6 months journey. And we are sort of on a good timeline. We are on pressing forward, and we'll be able to wrap up this 6 months. And then we can actually move into real strategy, where we will be making some real trades in our paper trading account. So again, thanks for listening, and I will talk to you in the next episode.